Hello, No Talks friends, and welcome to the Frankfurt Book Fair No Talks edition with a session on bank and future and fintech. But before we start, this is to remind you that this session will be fully in English with Arabic and French interpretation available. Make sure to just click on the globe icon at the bottom of the screen and choose the language you want. And as you go, please make sure to drop your questions in the Q&A, and I will make sure to convey them with our speaker. So, hello, Paolo Sironi. So, Paolo, you're the global research leader of banking at IBM and the best-selling author of Banks and Fintech on Platform Economies. Today is the anniversary of the launch of your book. Congratulations. And we're very eager to learn more about the findings of your book. So, could you tell us more about your personal and professional experience?
Well, first of all, I'm very happy to be here at the Frankfurt Book Fair and being hosted by you. And it is the first year since the successful launch of this bestseller, Banks and Fintech on Platform Economies. There are, if you like, three moments in my professional life. I used to lead the quantitative risk management departments in investment banking. So I understood all the scenes of the financial system. Then I built a startup dedicated to the development of digital wealth management solutions that was bought by IBM in 2013. And since then, I lead the global business research of IBM in banking and financial markets. And as part of this role, I'm also book author, and this is basically my last, which tries to give back what I've been learning through thousands of conversations with entrepreneurs, with colleagues, with clients, basically worldwide, in a way that we find the solution out of the conundrum for the financial system. All banks are looking for value. They need to build more value. Technology is an opportunity for building value, and value means creating economic systems and societies which are more inclusive and sustainable. So it's like a Copernican change in the way we define the role of banks. Is now looking more and more for stakeholder capitalism instead of shareholder capitalism. But again, we need a theory. It's like, if I can stretch it a bit, building a nuclear plant using the theory for, a carbon plant for making electricity, it will not work. So if you have a good theory, good foundations, you can understand value and you can digitize value to benefit the global economy.
Super interesting. And that concept of moving from shareholder to stakeholder and the creation of value. So in your book, Banks and Fintech on Platform Economies, you tap on how financial technologies can generate value in building a more inclusive world. So let's first set the scene. What is fintech? Why does it matter? And how can banks and fintech collaborate? Noting that many banks, they do perceive fintech as a challenge and obstacle for them.
Okay, so fintech is basically utilizing technology to transform financial services with a special impact on the relationship with the clients. Of course, banks has always been at the forefront of technology investment and utilization. So banking operates on technology. But the financial technology, so the fintech, is really about transforming the engagement with clients, partners, and also the employees. So it's a huge ecosystem perspective. The fintech movement started, if you like, 10, 15 years ago. Again, it's a Silicon Valley type of movement, as a lot of entrepreneurs with venture capital money thought they could basically insert themselves at the moment where banking was facing a crisis. We had the default of Lehman Brothers, so a lot of institutions were basically troubled. They realized their business model was not consistent anymore with the new economic conditions. But if there's something that happened, and I saw changing likely, because that has always been my advice, fintech started like narrow-minded or very focused businesses, of course, when you build a startup. And they basically thought that they could unbundle a bank, so they could break a bank into pieces and basically take away different opportunities in front of their client, engaging them with mobile technology, like on apps on the phone. The problem is that I've been, as I said, talking to thousands of entrepreneurs, and I'm also a co-host of Breaking Banks, the most famous fintech podcast in the world. We have like 7 million audience worldwide across the year. But I've been telling these entrepreneurs that they cannot break banks for the simple reason that banks are already broken. So the problem instead is the fourth industrial revolution is a platform revolution, and platforms are orchestrators of ecosystems. Now, platforms bundle back services in different ways. So if you build a fintech and you don't have a platform perspective, you're not going to make it happen. So that's the reason of this latest book, Banks and Fintech on Platform Economies, to help people understand how to transfer platform theory into financial services as it was born outside, leveraging ideas to build concrete business models and strategies which are defined in this piece of literature and come out of my professional experience.
Wow, this is a great, you've set the scene. Maybe I've noticed when you were discussing the impact of the macroeconomic landscape and the serious headwinds such as uncertainty, environmental crisis, wars, and so on. So what is the impact of such headwinds on the on fintechs, on the platform economy?
Okay,
and
so
the
let
cash
me
value?
say, that is exactly the starting point today. What I'm showing now on the screen is the 4 chapters, the 4 core messages that I want to share with the audience. And it does start with the macroeconomic conditions. In essence, it is not technology which is forces bank to change. Fintech is an opportunity for banks, for the financial system to change, to adapt to the new macroeconomic conditions. Once we define this, I will want to take you through an understanding of what it means to change. So we bring to the forefront the concept of the banking invention quadrant. We need the graph somehow, you know, to anchor our thinking. But then I will also help the audience navigate through the banking invention quadrant with concrete examples of fintech lessons learned. And so I believe that in the end, the last piece of today thought sharing is about what it means to change the mindset to unlock value. So we can, you know, bring all these pieces together. So let's start talking about what it means to adjust the business model to the new macroeconomic conditions. Now, I want to share with our audience, I hope everybody can hear, this speech of Kristalina Georgieva, so the chair of the IMF, who was interviewed, I think this is on the CNN in 2019, and she talks about uncertainty. That's way before the pandemic, the war in Ukraine, and everything we've been seeing and experiencing in the last 2 years.
Certainty is the new normal, and therefore we have to help our membership to be more agile, more adaptable to this fast-changing world.
So basically, she stresses the point that we live in a very uncertain world, and somehow, if you like, we forgot, especially in the Western world, because it seemed that growth could be never-ending, and the economy could continue become inclusive to expand the middle class and to build opportunities. In reality, this is not so, and it's not that the world became uncertain in the last 2-3 years. The world has always been uncertain, and the pain started building some long time ago. So in this graph, what I want to show you is the distribution of wealth in the United States, starting from 1910 to 2020, more or less. Look at the 1950 point where the 2 lines cross. So basically, the red line is the wealth owned by the top 0.1% of the US households. And the blue one is the wealth owned by the bottom 90%. You see they are more or less at the same level, 20%. Now, after the war, the US, which was the economic power that was, if you like, moving the creation of wealth around the globe, was a very inclusive economy. So you see that the share of the bottom 90% moved up to 35%, and the super rich owned less compared to when they started in 1950. But something happens in the 1990s. You see that the trend reversed, and now we are back to where we were in 1950. It doesn't happen overnight. It happens through time. And what happens in the 1990s is a transformation of the way banking worked. So is the internationalization of finance. So basically, it's putting the existing business model on steroid, which has an impact on society, where a lot of academicians realized that banking, finance started dominating the real economy. And in the way wealth was reallocated, there were consequences that reduced the inclusiveness of shareholder capitalism and basically transformed the trend to bring us back to where we started. So what we've been seeing in the last 2 years is just a reflection of what has been happening over time, though we may not have realized it. So now, where does this start from? This starts from the global financial crisis. Now, the global financial crisis represents the reason why the existing business models are not working anymore. And what I want to share with the audience is this speech of Alan Greenspan. Alan Greenspan was the chairman of the Federal Reserve at the time of the default of Lehman Brothers, and he is the creator of what is called the systemic put. That means the Fed intervening to save the economy. And Alan Greenspan realized that it was wrong. So that is the starting point of this book, the realization of what went wrong in the existing business models of financial services to find the solution for mending it. Can we share this one? Let me go.
Where do you think you made a mistake then? I made a mistake in presuming that the self-interest of organizations, specifically banks and others, was such as that they were best capable of protecting their own shareholders and their equity in the firms.
And now our whole economy is paying its price. You feel that your ideology pushed you to make decisions that you wish you had not made.
Well, remember that what an ideology is a conceptual framework with the way people deal with reality. Everyone has one. You have to exist, you need an ideology. The question is whether it is accurate or not. And what I'm saying to you is, yes, I found a flaw. I don't know how significant or permanent it is, but I've been very distressed by that fact. But if I may I just finish an answer to the question previously?
You found a flaw in the reality.
Flaw in the model that I perceived is the critical functioning structure that defines how the world works, so to speak.
In other words, you found that your view of the world, your ideology was not right. It was not working.
Precisely. No, that's precisely the reason I was shocked, because I've been going for 40 years or more with very considerable evidence that it was working exceptionally well.
So then you see, it's not me saying it, it's Alan Greenspan himself recognizing that the business models upon which the financial system was built was essentially wrong, so it could lead to collapse. And we saw in the reflection of the distribution of wealth in the US that has been happening. So now, here is the point. The interest rates you see have been going down. They were very happy. So everybody is trapped now into a conundrum, because even if the interest rate go up a bit to, provide more opportunity for banks and people, the inflation now is so high that it may create a stagflation. It typically may create an expansion of the economy. So banks will still be trapped in their capability to provide credit to the economy. They need to change the way they think about the relationship with the economy and clients. Now, to conclude my answer here to you, this is the point. Financial services are an essential part of the economy in an open world. Financial services are a platform. The economy is a platform. Society is a platform. The change of thinking and theory that Alan Greenspan has been looking for corresponds to an understanding of how platform theory intersects the business models in financial services. And to explain that, I want to let you listen to Mario Draghi at last. So Mario Draghi in 2019 gave this speech in the press room of the European Central Bank here in Frankfurt. A journalist asked him if negative interest rates, the quantitative easing that were a response to the financial crisis would create the next collapse of the financial system. And let's listen carefully to what he said, because it's very important in the conversation today.
Banks would like to have positive rates, unquestionably. So whenever they have negative rates, they don't like it. But I wouldn't go as far as saying the negative rates will cause the collapse of the financial system, because before getting there, one has to look at other things of our banks. For example, the cost-income ratio. Many of our banks have cost-income ratios which are completely way off any average indicator, both in Europe and even more so in the world, if compared with other banks in the other parts of the world. There are certain structural weaknesses in the banking sector, more pronounced in certain parts of the Eurozone than in others. I think these sort of considerations affect much more than negative rates, banks' profitability, banks' capacity to lend. The necessity to adjust the business model to the digitalization, to the changes in technology, is something much more compelling than being angry about negative rates.
So now Super Mario is great. I just have a better Italian accent than him, right? But what he says here is that he doesn't say that to resolve the problem, we need to digitize existing business models. He says banks have to adjust the business models to the opportunity that fintech provides to them. And the adjustment of the business models is what I try to address with this latest bestseller, Banks and Fintech on Platform Economy, thinking ecosystems instead of thinking linear businesses as in the past, because Alan Greenspan told that that is not going to work anymore.
Perfect. Super interesting discussion. And you started this section by stating that the reason why banks have to adjust is not about technology, right?
It is not.
But actually, fintech is the opportunity for banks to adjust their business models and to restart generating more value for the clients and hence the economy and society as a whole. But is this does it lead to sustainable finance? And can you explain what is a good business model for banks to adopt?
Okay, so change is not simple, but I find a way to represent what it means to transform the mindset to focus on a more inclusive and sustainable perspective, which actually is about, and I will explain in a moment, understanding two things. First of all, what is the real problem of people when they have to deal with financial issues like borrowing, investing, and saving, and what it means to move from an output economy, so an economy that is focused on products, towards an outcome economy, an economy where we focus on building outcome for individuals, for groups, for society, for countries, so on and so forth. Now, to understand that, I thought of leveraging again the European Central Bank, because after the speech of Mario Draghi, the researchers of the ECB published an interesting paper, Financial Intermediation with Technology, What's Old and What's New, which I invited the audience to read. Basically, they say that financial intermediaries, banks and fintech, exert market power so they can make it happen if they have superior information and communication. Now, we need to understand what is information. We need to understand what is communication. And then you see that with this understanding, we can build the graph that we have on the screen, so the bank innovation quadrant. Now, I know that people get anxiety when they see a graph, but don't worry. We can build it together, and we can get back to this one with the real examples and some cartoons to understand what it means. Now, what is information? Information is all the data that the bank owns in its core system, the core banking system. So it's about payments, it's about the credit functions, so the credit quality of the clients and the various products. Now, what the European Central Bank indicated, and it's particularly true for European banks, but is very true for all the banks around the world, is that given the current macroeconomic conditions that we discussed earlier on, it's very difficult for banks to reward shareholders by basically playing with the credit function, executing on the credit functions as they've been doing today, because the cost for the credit risk is very high, given the high uncertainty in the economy today and the low interest rates. Therefore, what they say is that the bank should build banking as a service infrastructure. It's the concept of open banking, open finance, so allow startup, third parties to access the information which bank owns, which actually is our information, the information about us as customers, and making it available to the startup for them to create new services and new solutions that make finance more accessible to the general public. And this is a financial inclusion perspective, right? You saw what happened in places like China and India, which are the real beneficiaries of fintech innovation today, because there you see most of the business models that allow technology to provide opportunities for banking the unbanked and let them participate into the economy, like the moms and pops in China, they started leveraging Alipay and WeChat in order to trade that favor and supported the economic growth of the Chinese dragon. But on the other side, the researchers also realized that banks will always be banks, and they also need to care about communication. And communication is the interface, is the human interface. A lot of decisions that families and entrepreneurs have to make are fairly complex, and typically they need to be intermediated by a conversation with an expert, with someone. Now, the problem is that that interface is becoming fairly expensive given the cost-income ratio of banks. That's why banks can now create banking as a platform, which is the other side of the banking as a service, where instead of positioning innovation inside out, they take the value of the fintech or third parties and they bring it inside the banking definition to create new services for clients that focus, as the ECB says, in the building of trusted advisory mechanisms. So they basically transform from distribution channel of products into advisory centers, more and more so, which has to be recognized and paid for their advisory role. Now, what I did in these banks and fintech on platform economies is to take information and communication and I made them the axis of the banking innovation quadrant. So if banks learn how to use technology to intensify the information quotient, so they move up, and intensify the communication quotient, they move right, they can go from lower business value, bottom left, to higher business value, which is top right. Now, you might ask yourself, therefore, where are the banks today? Well, most of the banks and the digital banks that we saw appearing, like the neobanks through the fintech revolution, are on the bottom left of this quadrant, this gray area. Now, think about what Accenture estimated a few years ago. They said that between 2015 and 2018, $1 trillion were spent by banks in technology, but more digital chrysalises was born instead of digital butterflies. Now, I can explain to you how to build these butterflies by looking at how to intensify the information quotient. That means understanding with platform theory the shift from selling products, output economy, to selling outcomes, the outcome economy, which is the essence of the platform revolution that wants to be more inclusive and sustainable. And also, I can let you understand that the problem of many clients in dealing with banking by understanding the difference between an offer-driven, so a push-oriented economy, and a demand-driven, a pull-oriented technology. The point is this one: mobile, which is the core of the fintech revolution, is a demand-driven technology. You don't go on Amazon to see what's going on. You go there with a purpose. But most of the revenues generated by banks, which are about complex financial decisions, operate in an offer-driven economy. So the question to be resolved is how you position an offer-driven economy on a demand-driven technology, and you have to think platforms to understand that. And once you do this, basically, you can achieve higher business value with these two strategies. We provide examples in a moment that are called contextual banking or embedded finance strategy, and conscious banking. That means people know that they are in a conscious banking relationship, and basically they get the advice they needed through a banking offer. And of course, I can overlap technology on top of this one to let you understand how you can get there. So it's a kind of a busy graph, but I know that we can get into any piece of this one, understanding the information quotient and the communication quotient with easy examples, so that we can give back to the audience made of interested parties, startup entrepreneurs, a way of navigating through, achieve higher business value.
So eventually, this is a streamlined roadmap for banks if they want to be more relevant and create value in the future. Just building again on technology and the role of cloud system and cloud computing. Banks and fintech will have to learn how to use cloud computing, big data, and artificial intelligence to do mainly two things. On one side, they can become invisible to and supporting the creation of new platforms and digital solutions. And the other side, banks can remain visible but improve their services. So what is the secret recipe for them to succeed?
Okay, so rightly so, there will be two types of strategies. One where the bank becomes invisible, contextual banking platform strategy, and one where the bank remains visible, which is the conscious banking, transparent platform strategy. Now, how to get there? The secret sauce is about moving along the axis, the information quotient and the communication quotient. Let's start from the communication quotient. So let's understand what is the real problem that people have to solve, and therefore the technology can help them solving. This is about the asymmetry of information, okay? Now, to understand the asymmetry of information, that means the difficulty of people to understand finance, we can leverage this cartoon. This is South Park. I guess that many of you know South Park. This clip was aired on American television in 2009 after the default of Lehman Brothers, and it's a short story. The little kid has some money to invest. He goes to his bank, and we want to see what happens.
I got $100 check from my grandma, and my dad said I need to put it in the bank so it can grow over the years.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
What's all gone?
The money in your account. It didn't do too well. It's gone.
What do you mean? I have $100.
Not anymore, you don't. Poof.
Well, what can I do to get back
I'm
my...
sorry, sir, but this line is for bank members only.
I just opened an account.
Do you have any money invested with this bank?
No, you just laughed it all.
Then please stand aside for people who actually have money with us. Next, please.
So now don't worry, these things don't happen in Frankfurt where we are now. But the key essence of this clip, apart from the deontological issues of banking, which are important, is that the little kid, which is the average client, does not understand finance. For him, it's very complex to make decisions by himself. So be demand-driven, pull solutions from the bank in order to move forward in his own financial life. And once we think about this, we understand that the difficulty that startups have to transform with technology financial services, because according to the type of business that they are in, they will have more like freedom to maneuver, or they will have more daunting problem to resolve. Now, to explain this, I can plot on this graph a typical banking institution. Using these two axes, you see the intensity of information, the x-axis, means the complexity of the problem, right? If it's an easy solution problem or if it's a complex decision in terms of financial problem. And on the vertical axis is the consumption model. Demand-driven means the problem is simple, so the client can make a decision by itself, doesn't need much. The problem is complex, so the client needs to talk to somebody typically to make a decision. And that divides a pull environment where people can pull, can take by themselves, from a push environment where typically they are offered the solution. Now, let's start from payment. So digital payments. Payments is a very demand-oriented type of financial services offering because the problem you have to resolve is simple. You buy a Gucci bag with one click on Amazon and you're happy. So the convenience of the one click is what you care about. There's no surprise that the biggest unicorn in fintech are all in payments or started in payments because they could quickly build huge volumes because they traded convenience of paying with the app, with a QR code, with a contactless solution in front of a broader public. But when you look at borrowing, which is another key business of a financial institution, so the credit function, that is a bit more complicated, right? Because typically it's very demand-driven because you get the money to buy the house or to fund your consumption habits, like buying a new fridge. But sometimes it's a complex decision you have to make because you want to have a bigger house because you have many children. So you need to think about it. So it starts to become a bit more complex. But what happens is that still you operate in a demand-driven economy. Let me give you this example. Please go to my website, thepsironi.com, and click on the first book image you see. And I will give you $1,000 that you can take, 0 interest rate, 0 commissions. You can give it back to me whenever you want. I'm sure a lot of people in the public are doing that right now, and please do so. Now, you will be happy. But I might end up with a credit problem, right? Because not all of you may have enough credit quality, so you may get into trouble. So that's what happened to many fintechs. They didn't understand that when it comes to borrowing and unsecured loans, it's easy to onboard people because they give money. But the problem of credit is that money needs to be repaid through the cycle. So you need to make sure that you help people understand whether they can afford the borrowing. That's the problem of buy now, pay later, for example, that might create a financial exclusion in the end because might force people to build up too much borrowing that they cannot afford. So it requires a deep ideological reasoning. All the peer-to-peer platform we saw appearing at the very beginning, most of them closed because they did not operate well, or they did not understand basically the difference between the two sides of the market, those that want to provide investing and those that need the money because they need the consumption. And the two are not just on the same side of the equation because one is on the push environment, the other one is on the pull environment. But now just think about what happens when somebody wants to use a technology to digitize investing, as many tried with robo-advisors or other solutions. Now, investing is up in the quadrant because it's very complex for people to trust where they put their money. So typically, a lot of people feel anxious to make a decision, and either they don't or they look for a conversation. Now, I'll give you another example for you to understand that. I invite everybody, you in the audience, to go back to my website, thepsironi.com, and now you click on the second book image you see, and you will give me $1,000 that I will invest into a portfolio made of cryptocurrencies, US stocks, Chinese stocks, but not those in Guangzhou because they pollute and you want to be sustainable. Now, I'm sure a lot of you are frowning, asking themselves, is it true that Paolo was a quantitative risk manager in a bank? Let's ask the UNDP whether Paolo really wrote books on portfolio theory as well. So there is a distance. So you need to get informed much more. You need to trust me to get into a conversation where you make a decision. That means I need to make an effort to offer to you something. Otherwise, you will not make a decision by yourself just because you see me on a website or you see information about me there. So that means that when you remove the intermediary, things happen. So it's way more complex for this startup, like the robo-advisors, to basically build inclusive investing without having a human relationship. That is therefore the role of artificial intelligence to help lower the cost of human relationships for people to be capable of accessing advice, which is now restricted only to the ultra high net worth. And the last example I want to provide to you of the complexities of using technology to transform financial services is insurance. Because insurance is the one dealing with the most complex problem, really uncertainty to the extreme, right? So event that doesn't really happen frequently. So now let me give you this example. I may want to sell to you life insurance, which is good for many people to have, but I have to talk to you to the fact that you're going to die. And you may not want to have this conversation with a chatbot to you. So then you see, that is where the intensity of the human relationship is higher. And that is the reason why I believe that Bill Gates was not right when he said that people don't need banks, they need banking, because that is only partially true. A lot of people still need bankers. The problem is that those bankers need to do a very different job from the past. And when they think platform economy, when they think contextual and conscious banking, they understand how to intersect with the problem of families, people, and entrepreneurs in different way to leverage technology basically to find solutions that enables them to be as much successful as the payment company when they go up into the value chain of the banking industry.
Great. So back to consumers, they are risk averse, and insurance, they have high risk to take. So you've mentioned that not all the narratives that we read on social media are correct. And for instance, those about millennials. And you said that digital is a technology of the demand, but most banking services are offered to clients. So, and this gap must be carefully understood to succeed with this digital transformation. Could you explain further what you mean by output economies and the difference with other concepts that you
Okay, this is very, very important, and it overlaps what we just said today. So the difficulty of people to understand finance, because it also enables us to understand what people really need when it comes to finance, which is not buying a product, basically, but resolving a problem. And that enables us to move on the vertical axis of the bank innovation quadrant now, understanding how to move up of the output economy and excel in the outcome economy, which is the essence of the platform economy that enables ecosystems to build outcome. Think about sustainability, better inclusion, right? Financial solutions. Now, let me give you this example. We are in Frankfurt, and of course, Germans love cars, and so do I as an Italian. Now, when BMW operates in the classical economy, operates in the output economy. That means they work with manufacturers, they assemble everything on the chassis, they create marketing to sell 10 million units of the new 7 Series. That's an output economy. They want to sell cars, assets. But BMW also realized that quite a few people don't need to buy the car or have no means to buy the car. In essence, they would want to drive a car to go from A to B. So they might be happy to use car sharing. So BMW partnered with Mercedes to build Share Now, which is a car sharing app. Now, few things happen when you think about building a platform for car sharing. First of all, the assets, the products don't disappear. Somebody has to produce the car, and somebody has to buy the car. But it's not the client, us, that buy the car anymore. It's the car sharing app. If you don't buy the car, you're not linked to that asset, because suppose you spend thousands of dollars to buy a BMW, and then you don't like the way it steers on the road, you cannot give it back, right? Typically, you have to keep it a few years, and then you have to return it and change it. But if you don't like the experience when you use a car sharing app, you can quickly move to another car sharing app. That's why on the platform economy, on digital, experience and engagement are way more important than the asset. And you really need to excel there, because the stickiness of clients is not there. So you need to make a bigger effort. Second thing that happens, the monetization is different. You don't pay the product, but you pay for the journey you make from A to B. Now, what does it mean in financial services? It's basically very similar. So far, banks have been operating in the output economy. That means the banks wants to sell $1 billion of a monetary fund because it takes commissions out of the dollars sold to somebody, to an individual. That is the output economy. But banks are now realizing, especially because those margins in the products are smaller and smaller and smaller, that their role is to help families, individuals, entrepreneurs to fulfill their personal, their business, their financial goals, those outputs. So going from A to B. Now, again, like before, the assets, the financial products don't disappear, because you still need to invest into a sustainable ETF or to get credit to buy a house. But the profitability of the bank is lower and lower anyway because of the macroeconomic conditions on the assets. So the value is now positioned in the advisory element that help people move along their life journey, their life cycle, to build outcome, basically to fulfill their personal, their business and financial goals. And this is a Copernican revolution, because it really changes the way bankers work and the way bankers get paid. It changes the way bankers demonstrate value for clients. And without technology, it would be very difficult, even in human businesses, to explain to clients the value of the relationship, to be paid for the relationship. And that's why shifting to the outcome perspective on platform economies is essential for banks to understand how to use fintech to build a new financial services model that intersect with the ecosystem to make it more sustainable, more inclusive, and more successful, notwithstanding the high level of uncertainty that we all have to face in our life today.
Thanks for this comprehensive answer. And we were receiving several questions from the audience. We do encourage you to keep dropping your questions in the Q&A in any of the 3 languages, English, Arabic, or French, and then I'll convey them with the speaker. So in your discussion, you have mentioned the importance of moving towards more client journeys and their experiences. Can you give us some more examples in real life about banks and fintech that are moving in the right direction?
Well, yes, we said that this is the bank intervention quadrant, right? So we learned that in order to get from the gray area to the blue area, we need to think outcome economy, not products, and we need to think how to help clients to self-direct themselves or to enter into a relationship in order to be capable of using digital by themselves. And that means contextual banking and conscious banking. So how we can explain them and what are the examples? Well, first of all, how do we define contextual banking? So open banking, open finance. It is now the opportunity to eliminate the ecosystem friction. So to help people do things faster, like pay-per-click, that makes banking contextualized, so embedded, invisible, to unlock new value. So now there are today not just non-banks, but also banks that want to build ecosystem platforms, for example, to help the farmers resolve their problems, so their business problem, and use finance in order to help them to trade on digital, to share the crops, but also leverage other analytics like the weather analytics to understand where they have to put the money in terms of investing in a certain producer, not the one thinking about the climate cycle. And there is the other tension we can see here, where instead there are banks that needs to demonstrate value for clients, which is the conscious banking. That means they need to eliminate the knowledge friction, which I guess is very important today. We said that a lot of people don't understand finance. So the biggest friction is for people to have enough knowledge to understand the financial problem. And that makes banking conscious. So giving people advice to unlock the hidden value in the relationship, which is what the relationship is about, is sharing knowledge among people to know what they're doing. So now here are, I thought I had the example on top, but I can tell you. In contextual banking, you have, for example, in India, SBI Yono. So State Bank of India is the largest bank in India. They created You Only Need One, which is a marketplace where they can buy products, but it has a digital wallet inside and a digital bank on the side that can also engage people with banking relationships. Or Bank of Baroda in India as well, which is a solution for farmers that enables them to access other opportunities like leasing for their machinery, so on and so forth, but as part of their business problem, not as a separate solution. Or DBS in Singapore, which has been building various ecosystem platforms for travel, for real estate, or for cars. And in conscious banking instead, you see a lot of banks which are trying to move into the relationship problem, transforming their remuneration in terms of the client fees. I'll give you a quick example to understand. If I ask you which is the biggest bank in Switzerland, what would you say? People might say UBS, wrong. If I ask you the second largest bank in Switzerland, people may say Credit Suisse, wrong. And you're wrong because 3 years ago, the FTSE Russell took UBS and Credit Suisse out of the banking index, saying that they're not banks anymore. They are wealth management, asset management institutions, because most of the remuneration don't come anymore from traditional banking, given the macroeconomic conditions, but relationship with clients, where clients ask more and more to pay for accessing their relationship. Without technology, that will not be possible. It will be very difficult to justify that. So this is basically the shift, to focus on the knowledge and not the product which is shared with clients, and to be paid for that knowledge instead of the financial products in the end.
So we have a question from the audience which relates to this point and has to do with financial literacy and financial inclusion. So what's the role of financial literacy in this model?
The financial literacy is just the starting point, I have to say, because not enough. It's super important. However, you see a lot of traders also have high level of financial literacy, but don't necessarily make the right decisions. The point is, you need to understand the techniques. You need to know what happens with the bond. If the interest rate go up, the price of the bond is going down like it is today. But then what matters really is that you can enter into a relationship with someone, can be a digital solution in some cases, or a human help by digital, where you keep on testing your assumptions to remain sober, to avoid the fear of missing out, which basically affects the fate of the investments of so many families, which come later to the journey, right? When the market is at peak, and then they lose a lot of money because then there is a downturn, because it takes time for people to start trusting the narrative. They invest at the late of the cycle and then they lose the money. So the point here is that knowledge is not just normative, it's just the starting point of financial education. But the real knowledge, which corresponds to a high level of consciousness, is about entering into a relationship where you can continuously test your assumptions to be really anti-fragile, so that you can lose some money today, but you were so sober that you can remain invested through the cycle, so you catch up with your losses and you can continue basically building opportunities for your financial future.
All right. We do have another question also to the role of regulators and the government. Like we presented a model, we, we haven't seen much about the role of the government and the stringent, regulations.
Oh, well, that's
How could, if you want, how could the government be more enabling?
That's very important. This is my fifth book, and it's based on my fourth, which is the theory and principles of financial market transparency that I launched at off Davos during the World Economic Forum in 2019. And I presented in the press room of the European Central Bank opening a decentralized finance seminar with the title A New Business Model for Central Banks, Regulators, and Financial Institutions. So in essence, the core of this is the following. On platform economies, platforms are successful because they eliminate frictions and they trigger positive network effects. So everybody wants to engage in a different way because it's more valuable, it's more convenient. It's valuable for the people on the ecosystem, for the ecosystem. Now, in financial services, the role of regulators is basically to leverage transparency-led regulation to trigger the consequentialist ethics, so a change in agents' behavior that is a response to Alan Greenspan when he said the agents are not rational, and that corresponds to the positive network effects in a way that the system starts building value again, creating more value for clients and therefore more value for shareholders. But you have to build the full picture, which is stakeholder capitalism, starting from financial services. So in essence, the role of governments, so policymakers, and the role of regulators is to understand how regulation can help transform the way agents operate so that we can shift on these very different macroeconomic conditions from an output-oriented financial services economy into an outcome-oriented financial services ecosystem.
So Paolo, you have been a startup entrepreneur yourself, right? So what do you want to share that you believe is important for any startup working in financial services?
Well, I want to share this story, and it comes at hand because we are at the Frankfurt Book Fair. Essentially, in the 1990s, where I was a risk manager for a bank, I also helped my brother to build the Amazon of Italy. And don't laugh at me, because we had at hand the best assets, the best products in the world. Sorry for the audience, is Italian fashion, Italian food, Italian furniture, and Italian travel.
Lebanese food, maybe.
We had a wonderful website. We had the super cool for a time payment mechanism on mobile, on the internet, and we didn't sell anything. It was a big failure, okay? So we made many mistakes, but there's one that is very important that I want to share with all of you that I learned when I listened to a Jeff Bezos interview about Amazon a few years after, and there was an interview a few years before when Amazon at the beginning of the 1990s was primarily a place where you could buy books or sell books, and we are at the Frankfurt Book Fair today. So basically, the journalist asked Jeff Bezos in the early 1990s, what's Amazon? And Jeff Bezos says, Amazon is not a distribution channel of books on the internet. I was puzzled. Output economies, quantities of books. So the question is your bank, is your fintech on mobile a distribution channel of financial products, output economies, or not? So now let me explain to you what Jeff Bezos said. He said, you see, publishers, there's so many publishers here at the Frankfurt Book Fair today, are complaining with me because they say I don't understand marketing. Now, call Jeff Bezos stupid. I will not do that. And he said the reason is because I allow the users to publish positive and negative reviews on my web pages. And they say, only post the positive reviews so we can sell more outputs. But he said they're wrong because the manufacturers are not my client. My client is you and me, everyone in the audience. And the problem of my client is that when they come on my platform, he said, they might be there, but they don't know what to do because they cannot take the book in their hand. I always do this. I smell the glue, and I did the same. And to make a decision, I want to talk to somebody, right? So they may be there, but they cannot pull the pull mechanism again, right? So they cannot make the decision. So he said transparency, which of course is made of positive and negative reviews, which can be abused. And that's why I have a regulatory perspective around that, is the mechanism that builds trust. So people can self-direct themselves. They can pull the choice from the platform and they can buy the book. And only after, he said, I can use other analytics, data-driven banking in order to move the client around. So he said, my role is not to sell books. My role is to advise clients on which is the best book to buy. Again, the trusted advisory perspective that the European Central Bank basically indicated. So this is the same thing that needs to happen in banking, where the problem to be resolved on the asymmetry of information is way more complex than Jeff Bezos, because we said buying a book is easier than investing on a complex monetary instrument. If not for the reason that on Amazon, if you don't like my book, you can send it back. But if you don't like your investment, you cannot send it back, right? So the effort you need to make is higher. And that's why knowledge is of essence. The scope of banks and fintech on platform economies is to transfer knowledge to people in a way that they are capable of pulling with more autonomy, financial services opportunity for the better future.
Interesting tips. One question from the audience relating COVID and the pandemic, and how does it affect the use of financial management solutions?
Oh, what happens? That's very, very important, actually, because if we learned something, so banks through the pandemic, is that relationships are important, right? So you needed to keep a proximity. And the only way to keep the relationship was to use digital tools. So banks has always been, if you like, covered by the fact that a lot of people, especially in the Western world, preferred to go to a branch still compared to Asia Pacific in order to do a banking transaction. But through the pandemic, they couldn't do that. So digital adaptation accelerated extremely through the pandemic. And that, if you like, pushed banks to realize that they were not moving faster enough because they were losing proximity with the client. So a lot of people, especially in the Western world, learned that they could use digital. So they started demanding effectively more from their banks in order to basically access those services, which unfortunately happened because of the pandemic, but had a benefit impact, if you think about it, in terms of the understanding from the banking suite of the importance of digital to transform the way they talk and they keep close to the customers.
Great. And by that, we would reach the end of the session. Thank you so much, Paolo, for this insightful discussion. And thank you for the audience who attended this session. And stay tuned for the next session at 1 p.m. Frankfurt time. See you all. Bye. Oh.
Thank you.
Thank you, Paolo. And you can check the book on Amazon.